Hey guys, today we're talking about March 10th, 2000, the literal peak of the dot-com bubble. On that day, the NASDAQ reached an intraday high of 5,132.52, and it was a long time before we saw that again. How long? Well, let's put it this way. On March 10th, 2000, Bill Clinton was President of the United States. On June 16th, 2015, Donald Trump rode down that escalator and announced that he'd be entering the Republican presidential primary. And at no point during that entire span did the NASDAQ achieve a new all-time high. The way we're going to be looking at this moment is not via retrospectives. People's memories aren't exactly the most reliable thing, and even when they are, people can claim one thing while remembering another. So instead, I'm going to look at newspaper articles and message board posts published exactly on that date. Why are we doing this? Because it's interesting, I guess, but also because it's starting to sound an awful lot like the year 2000 out there, and maybe we'll learn something about when to cut and run. First up, we've got CNN Money's recap of the prior day's action entitled, almost nihilistically, NASDAQ sets record again, which sounds sort of like today's stonks only go up mantra. It's surprising then to read a little further down that decliners had pretty dramatically outnumbered gainers, both on the New York Stock Exchange and on the NASDAQ itself. In other words, things were getting really top-heavy at this point. The New York Post, on the other hand, hadn't lost its capacity for wonder, titling its general news article, High Fives, Tech Stock Index Hits Milestone. And in the business section, it was a little bit more subdued. They just called it NASDAQON Fast Track, Hits 5,000. These articles have the benefit of some beautifully incorrect quotes when looked at with hindsight. Ralph Acampora, chief technical analyst at Prudential Securities, told the paper, "I think we can see NASDAQ 6,000 in the next 12 to 18 months. Dennis Peacock, a broker with AG Edwards, said, "We're still in an extremely strong bull market. I believe the NASDAQ is still undervalued and could go much higher." And Lawrence Kudlow of Schroeder & Co. said, "There's no recession in sight and no inflation in sight. I think the power of the NASDAQ is going to pull up the other indices, and everyone in America is going to love that." Spoiler alert, there was a recession in sight. Also, it's worth noting that you may better recognize this Lawrence character as Larry, President Trump's director of the National Economic Council. Also, although I hadn't heard of Ralph previously, Fox Business describes him as a world-renowned technical analyst. So, I'm not picking on these guys for being wrong. Obviously, no one bats 100%, especially in financial predictions. However, it's important to recognize that you can't expect the experts to be the people who are going to save you when you're about to go over the cliff. The risk of being a contrarian in that sort of situation is just too high. When you're the only one who's wrong, you probably get fired. When everyone gets it wrong, then you can just throw up your hands and say, well, no one could have ever predicted this. For someone to, predict that things are going to go wrong and be correct and be on time is basically so rare that if you get it right, they'll make a movie about you. One more interesting thing on the experts is that not only did they get it wrong, but they really got it wrong twice in about 3 months. The Fast Track article included the fact that in their year-end predictions, top strategists at the biggest brokerage houses came up with the consensus estimate that the NASDAQ would end 2000 at only 3,805. So, at the beginning of the year, the predictions were for 3,800. Then, when the NASDAQ overshot that by 30% in the first 3 months of the year, instead of people thinking, something is not right here, they instead decided to reverse course and say, well, actually, it should probably be higher. Next up, we've got an article from the Wall Street Journal. It's entitled, "Who Can Carry the Baton in the Run Towards 6,000?" It points out the interesting phenomenon that stocks that push the 4K race, including behemoths such as Microsoft and Dell Computer, as well as trendy starlets such as Qualcomm and Yahoo, gave way to 5K upstarts such as PMC Sierra and JUNIPer Networks. The tone of the piece is more measured. Richard Weiss, a manager at Strong Opportunity Fund, notes, "It's like gravity has ceased." And Ruth Porat, a managing director at Morgan Stanley Dean Witter, then nails it in her prediction when she says, "Our expectation is that we are going to see a lot of carnage in the area. The winners will be huge, but it reemphasizes that you need to be selective." I figured I'd check out Ruth to make sure that she didn't end up fired for daring to urge some caution, and my faith in the business world was somewhat restored because as of this year, Forbes named her the 16th most powerful woman in the world. She's now the CFO of Alphabet, so congrats. The point of the article is interesting in that it suggests that at some point, your market's biggest stocks just can't grow as much. To flip a market cap 100% from 100 billion to 200 billion is going to be much easier than it is going from 200 to 400, and so on. If you're already pricing in world domination, where's the upside going to come from? Plus, taking over everything creates a cap on share price in another way. Antitrust. See if this sounds familiar. On March 10th, 2000, Microsoft was in the heart of its battle with the Department of Justice, trying to prevent them from forcing it to be broken up. Of course, that moment is the ancestor to this year's governmental challenges that the big tech companies of Google, Apple, Facebook, and Amazon are facing, coming both domestically and abroad. This got me curious if antitrust is a top indicator, so I checked out AT&T, which was investigated and then officially charged in 1974, and wow, if we go into a steep decline in the next year or so, this is one signal you're probably going to want to file away for future use. Back to smaller companies leading an index higher, I looked into whether FANG stocks had also begun needing a breather versus the rest of the NASDAQ, but aside from a brief period a few months ago, that's not the case. So that warning light isn't quite flashing yet, I guess. And that's an important note. You can be in a bubble similar to what preceded the dot-com crash, but if it's 1998, you've still got 18 months left to party. I also went ahead and compared the charts of the behemoths listed in the article versus the upstarts. See if you can't spot a pattern there. I get the sense that we're going to see a lot of that. Any sort of bubble popping is going to end up as just a blip on someone like Amazon's long-term chart, but for the small caps that mark the top of the bubble, even if they survive, things will never be the same. Finally, we've got an article that's subject matter was almost too perfect for this. The Wall Street Journal ran a feature titled, "Conservative Investors Warm Up to the Idea Tech Sector Isn't a Fad." It recounts several investors who had resisted tech and its crazy valuations and lack of profit for as long as they could, but they'd finally been broken. I mean, how could they have not have been, though? The article brings up that specifically in the second half of the year, according to Merrill Lynch, stocks in young technology companies that were losing money outgained, on average, stocks in companies with earnings. That is a pretty tough investment environment if you're trying to be a value investor. Plus, it reinforces the idea from the other article about how the giant companies were no longer the ones that were leading the market higher. It's like that character on Silicon Valley says about making money.
If you show revenue, people will ask how much, and it will never be enough. The company that was the 100xer, the 1000xer becomes the 2x dog. But if you have no revenue, you can say you're pre-revenue. You're a potential pure play. It's not about how much you earn. It's about what you're worth. And who's worth the most? Companies that lose money.
So the wise old value investors just sort of had to sit there and watch, as the journal put it, the dumb money has been laughing all the way to the bank. It is the skeptical money and the investment pros that has been hurting. When they gave up, here's what it looked like. They follow one guy called Charlie Wolf, who's described as meticulously building a conservative stock portfolio since the mid-1980s. And he said that originally he felt better with safe blue chip names such as DuPont, Johnson & Johnson, and Procter & Gamble. But suddenly he just decided, I think Cisco Systems and Lucent, the Oracles, the WorldComs, and the Vodafone are the core stocks to hold for the future. Do we have dumb money now? Boy, we definitely do. Is the dumb money absolutely crushing it? Definitely. And let's check. Does dumb money from back then sound kind of the same as the dumb money from today? Well, let's check out what's going on the Cisco board March 10th, 2000. And we've got people that are really kind of confused by the fact that Cisco is about to split, and they're trying to get answers, which sounds an awful lot like what was going on a couple months ago when Tesla and Apple were splitting, and people were turning to their TikTok advisors to figure out what it meant for them. But back to the core of the article, there's a legend about how in 1929, the fact that shoeshine boys were giving out stock tips should have let people know that a crash was coming. That doesn't seem like the most compelling indicator, though. If someone's going to see all the people around them making what seems to be easy money, it's only natural that they're going to try to get some of it too. And these days, the barrier to entry is as low as it's ever been. You just need a phone. No, this article gets to exactly what that top indicator is. It's the surrender of the people who claim that they're the smart money. Once they're buying in, then the bubble can't have too much longer to go because there's not going to be anyone left to buy. This doesn't feel like what's happening yet. Value hammering growth is sort of a meme on financial Twitter, but it wouldn't exist if people were not still clinging to value. And Warren Buffett hasn't started a SPAC yet, at least as far as I know. So, are we on the precipice of something bad? That's not really what this channel is about, but I will say that for all the similarities I'm drawing, there is an especially fat elephant-sized difference. Just about all the articles I talked about here also make note of the fact that the Fed funds rate may be set to rise, and it's already in excess of 5%. Today, that rate is basically zero. It's kind of like the market gets to taunt you. Sure, there's some signs of a bubble going on, but what are you going to do? Put your money in a CD? So I guess whether this is it or there's years to go, you're just going to have to dance while the music's playing. Thanks for watching, guys.